Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Today on the podcast, our views on tariffs and the implication for equity markets. It's Monday, March 31st at 11:30 a.m. in New York, so let's get after it. Over the past few weeks, tariffs have moved front and center for equity investors. While the reciprocal tariff announcement expected on April 2nd should offer some incremental clarity on tariff rates and countries or products in scope, we view it as a maximalist starting point ahead of bilateral negotiations as opposed to a clearing event. This means policy uncertainty and growth risks are likely to persist for at least several more months, even if it marks a short-term low for sentiment and stock prices. In the baseline for April 2nd, our policy strategists see the administration focusing on a continued ramp higher in the tariff rate on China, while product-specific tariffs on Europe, Mexico, and Canada could see some de-escalation based on the USMCA signed during Trump's first term. Additional tariffs on multiple Asia economies and products are also possible. Timing is another consideration. The administration has said it plans to announce some tariffs for implementation on April 2nd, while others are to be implemented later, signaling a path for negotiations. However, this is a low-conviction view given the amount of latitude the president has on this issue. We don't think this baseline scenario prevents upside progress at the index level, as an off-ramp for Mexico and Canada would help to counter some of the risk from moderately higher China tariffs. Furthermore, product-level tariffs on the EU and certain Asia economies, like Vietnam, are likely to be more impactful on a sector basis. Having said that, the S&P 500 upside is likely capped at 58 to 5,900 in the near term, even if we get a less onerous than expected announcement. Such an outcome would likely bring no immediate additional increase in the tariff rate on China, more modest or targeted tariffs on EU products than our base case, an extended USMCA exemption for Mexico and Canada, and very narrow tariffs on other Asia economies. No matter what the outcome is on Wednesday, we think new highs for the S&P 500 are out of the question in the first half of the year, unless there's a clear reacceleration in earnings revision breadth, something we believe is very unlikely until the third or fourth quarter. Conversely, to get a sustained break of the low end of our first half range, we would need to see more severe April 2nd tariff outcome than our base case, and a meaningful deterioration in the hard economic data, especially labor markets. This is perhaps the outcome the market was starting to price on Friday and this morning. Looking at the stock level, companies that can mitigate the risk of tariffs are likely to outperform. Key strategies here include the ability to raise price, currency hedging, redirecting products to markets without tariffs, inventory stockpiling, and diversifying supply chains geographically. All these strategies involve trade-offs or costs, but those companies that can do it effectively should see better performance. In short, it's typically companies with scale and strong negotiating power with its suppliers and customers. This all leads us back to large cap quality as the key factor to focus on when picking stocks. At the sector level, capital goods is well positioned given its stronger pricing power, while consumer discretionary goods appears to be in the weakest position. Bottom line, stay up the quality and size curve with a bias towards companies with good mitigation strategies, and see our research for more details. Thanks for listening. If you enjoy the podcast, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.